Okay, so that was kind of the boring theory at the beginning. Let's get into actual bond valuation. So the first thing you want to understand is that there's a difference between the price of a bond, which we often call the market value of the bond, and the face value. Okay. In my timeline that I drew before, the face value is at the end. But when you're buying the bond, you're not buying it at the end, you're buying it at the beginning. And you're paying the market value. So the investor will pay the market price. Investor pays market value when they buy the bond. And we're going to see later on that the market value could be more than the face value, it could be less than the face value, it could be equal to the face value, but it is not necessarily equal. Now, the way that we find the market value of the bond is just using basic TVM. It's the present value. The price of a bond is the present value of all the coupon payments, all remaining coupon payments, and of the face value. So essentially, we're going to discount back all of the coupons and the face value, and whatever the present value is, that's the value of the bond. The rate that we use is called the market rate or the yield to maturity. They're not technically the same thing, but they're very, very, very closely related. And in this chapter, we're going to use those interchangeably. The market interest rate and the yield to maturity, for now, are effectively the same thing. And basically what it is the global interest rate in the market, corresponding to the level of risk of this bond. Now, every bond does not have the same risk. That's why every bond doesn't have the same yield to maturity. Some companies are just riskier than others. And the basic rule when it comes to investing, and not just for bonds, but for anything, is the riskier the investment, the higher the required return. And that's logical, right? Think about it. If you were to invest in something that was very risky, you would only do it if you had a high, if you were expecting to make a lot. Otherwise, you wouldn't do it, right? So think of the market interest rate and the yield to maturity as representing the required return on the bond given how risky it is. Now, what the yield to maturity actually is the annual return on investment that you would earn if the bond is held until maturity. Okay? So if you were to buy a bond today at whatever the price is, and you keep that bond until maturity, your annual rate of return would equal the yield to maturity. That's where the name comes from. The word yield just means return. So return to maturity. It's your annual return if the bond is purchased today at whatever the market price is and held until maturity. And then you've got two additional other assumptions, assuming that you receive all your coupons and that you reinvest them at the same yield. Okay, so that's like the long definition. The annual return you earn if you buy the bond today, you keep it until maturity, you collect all your coupons, and you reinvest all your coupons. Okay. In a nutshell, or a very, very, in a simple way of saying it, guys, the yield to maturity is your return on investment. It's your annual return on investment. And it's known from the start. And that's what's cool about bonds. As long as the company honors its obligations, pays you on time, pays you the amount they're supposed to pay you, you know exactly what you're going to earn from the day you buy the bond, as long as you keep it until maturity. Now, if you decide you're not going to keep it until maturity, that's a different story, and we'll talk about that later. So here's the formula to find the price of a bond. It's actually a combination of two formulas. This is an ordinary annuity because the coupon payments follow an ordinary annuity kind of cash flow. And then you've got a lump sum at the end because the face value is a lump sum. Now, for those of you using financial calculators, we can also do this on the financial calculator. And then underneath you have the coupon payment formula, which is the face value times the coupon rate divided by your compounding or your payment frequency. One thing to know about bonds is that your M and your F are always the same. So if a bond pays coupons semi-annually, it compounds interest semi-annually as well. So there's never a situation in a bond where you have, semi-annual compounding, but quarterly payments or anything that we saw maybe in the TVM chapter. Here, you always want to assume that your payment frequency or your effective frequency and the compounding frequency are the same, right? So it makes it simple. It makes it so simple that you could basically say that your discount rate is the YTM divided by your compounding. You don't need to use the long effective rate formula when you have your YTM, because the YTM, the yield to maturity, this is basically the equivalent of APR. It's an annual percentage rate. It's always expressed annually. It doesn't consider compounding. So we want to divide it by the frequency to get our effective rate. Okay, so you can add that into your notes, your discount rate. And again, if you use R, then call it R. It's YTM divided by your compounding frequency. Okay, we'll have a chance to do all these in a second. So the coupon rate. You see it here as part of this formula, but I want to talk about what that is. The coupon rate has a single function. First of all, it's determined by the issuer. So when the issuer, if you remember when I started here, I said the issuer determines, what the face value is, what the length of the bond is, and what these payments are, right? What are the periodic interest payments? Well, the way that they determine the periodic interest payments is by setting a coupon rate. So the coupon rate is simply the percentage of interest that the issuer will pay every year to the holder. The percentage of interest that the issuer will pay every year to the holder. And it's a percentage of the face value. So for example, okay, let's put this aside for a second. Let's say you have a $1,000 face value bond. And by the way, the default face value on a bond is 1,000. If ever you're reading a question and they just have not said what the face value is, assume that it's 1,000. So let's say you have a $1,000 face value bond with a coupon rate of 7%, and it's paid semi-annually. Okay, and let's say that just for the sake of this example, it has a 2-year maturity. When you read something like this, what you have to imagine is this timeline. If you took the 7%, so if you follow this formula, right, your face value is 1,000, your coupon rate is 7%, and it's divided by 2 because it's paid semi-annually, which is $35. It means that every 6 months, so 2 times per year, the issuer is going to pay $35 in interest to the holder. So if you're the investor, you're actually getting $35 in cash deposited into your account every 6 months. And on top of that, you're getting $1,000 at the end. So this means these payments for both the investor and for the borrower. It's just for the investor, this is money coming in. For the borrower, this is money going out. This means this. And in a second, we're going to take this and find its present value. Okay, but for now, just understand how to read it. So now you want to, again, before we get into the actual math side of it, we want to make sure we understand the relationship between the coupon rate and the yield to maturity. And there's basically 3 things you want to know. When the coupon rate is small, so smaller than the yield, the bond will trade at a discount to par. And what that means is that the price of the bond, or the market value of the bond, will actually be less than the face value. So if you wanted to buy a bond that was trading at a discount, you could pay less than the face value to buy it. So even though at the end, the face value is 1,000, maybe you can buy it today for 900. Maybe you could buy it today for 850. But if the coupon rate is higher than the YTM, it's the opposite. We say the bond trades at a premium. So you would actually have to pay a premium. The price of the bond today would be higher than the face value. And if they're equal, we say the bond is at par. And when a bond is at par, the market price or the present value is equal to the face value. So only in that case are they actually the same. So you definitely want to know this. It comes up on pretty much any exam in any class. It's the most basic theory when it comes to bonds. Now, a couple of things that are a little bit less known. One is the return to par. Now, it's less known because students don't really test on this all that much, and students kind of ignore it as a thing that doesn't really matter all that much. But I think it does matter. So now you're starting to see that the price of the bond and the face value are not the same thing. The face value, right, if you were to put them on a timeline, is at the end, and the price is at the beginning. The investor will pay the price, so think of the price as an outflow, and they're going to get the face value at the end. And we saw here that the price could be less, the price could be more, or the price could be equal. Now, what you need to understand is that they are related, okay? The return to par assumption basically states that as we approach the maturity date, the market price will approach the face value. As long as the market interest rates don't change, as long as the yields don't change, if everything pretty much stays the same in the economy, as we approach maturity, the price or the market value will get closer and closer and closer and closer and closer to the face value until eventually it reaches the face value. So we say that at maturity, the price of a bond is equal to the face value. So if you bought a bond for a premium, that means that bond is going to decrease in value every year. Because a premium means that the price is higher. So you're going to pay, let's say, $1,200, but that price, that $1,200 value, will shrink and shrink and shrink and shrink each year until it reaches the face value of 1,000. Okay, so try and imagine it on a timeline. I know it's a lot of information. Soon we're going to do an actual math example, and hopefully that'll kind of put this all together. But let's say you buy a bond today for $1,200, right? Because that was the price of the bond, but the face value is 1,000, right? This is what you would call a premium bond. A bond where the price is greater than the face value. Well, a year from now, this price, and these numbers are completely made up, might be $1,150. A year after that, it might be $1,097. A year after that, it might be $1,042. A year after that, it might be $1,010. And at maturity, it's going to equal 1,000. So even though nothing changes in the economy, the value of your bond is always going to return to its par value. A discount bond does the opposite. A discount bond is one that you buy for a discount, right? So we know it's going to mature at 1,000 because that's the face value, but let's say you paid $850 for it, right? Again, assuming nothing changes in the economy, 1 year later, it'll be worth more. The year after that, it'll be worth even more, then even more, then even more, until eventually it reaches 1,000. The price returns to par. Now, we'll talk later on about what happens if the economy does change, right? So then the assumption here is that nothing changed in the economy. The interest rates are the same. The yields are the same. Your bond is just getting closer and closer and closer to maturity. So that's what's summarized here. And then one question that I always get from students is, I just don't understand the difference between the coupon rate and the yield to maturity. And typically that's because we tend to overthink what the coupon rate is. So the coupon rate is strictly telling us how much cash the company has to give to the holder every year for interest. Nothing else. And it's based on the face value. But the yield to maturity is the actual return on investment, and it's based on how much you invested. It's based on the market price. Okay? So think of the coupon payment. The coupon rate is just, this is my payment, my periodic payment, the periodic payment I'm receiving. But the YTM is my actual return based on how much I invested up front. And that's the number that truly matters. The coupon payment, it matters, sure, but the yield is everything. Because a bond that has a 20% yield to maturity means you're going to make 20% per year return on your investment. But a bond that has a 20% coupon rate means you're going to get paid 20%, but that's not necessarily a good thing, because what if you paid a lot for that bond? So the yield is the true marker of how much you're earning on your investment. That's what a return on investment is. So Let's do our first example. So I'm going to solve this question twice, once using this formula and once using the financial calculator for those of you that are using the financial calculator. Okay, so let's take a look. A bond with 10 years remaining until maturity. And you don't have to draw timelines when it comes to bonds, but I will just for today so that you could really start to wrap your head around what it is. It's a 10-year bond. 6% coupons paid semi-annually. So let's freeze there. Remember, the coupon formula is the face value times the coupon rate divided by your frequency. So if it's a $1,000 face value with a 6% coupon rate paid semi-annually, that means you're getting $30 every 6 months. So there's going to be a total of 20 payments because it's a 10-year bond. So 10 times 2. There's going to be 20 payments of $30. And at the end, there's also going to be a payment of $1,000, right? That lump sum that you're going to get. So put yourself in the shoes of the investor. Now you know, if I buy this bond, every 6 months, I'm going to get $30. And at the end, I'm going to get $1,000. The question is, how much are you willing to pay for this bond? The bond is yielding 9%. So your K, or your R, depending what you like to use, you're going to take that yield to maturity and divide it by your frequency. So if it's 9%, we're going to do 9% divided by 2. So we'll use 4.5% as our discount rate. So then if I follow the formula, it's the coupon, so 30, 1 minus 1 plus K, so 0.045. My N is negative 20 because there's 20 payments, 0.045. Just like we did in the TVM chapter, guys. That part is just an ordinary annuity. Plus, we have to discount the face value. So 1,000 divided by 1 plus K to the N. So the first part here is the annuity. So that's to discount all of your payments, right? That's to find their present value. And then the second part, this part here, is just for that lump sum at the end. Punch it into your calculators and you'll have your price. Now, for those of you using a financial calculator, you're going to enter your payment as 30 because the coupon is your payment. Your I over Y is the 4.5. It's the same things. You're just punching it into your calculator instead. You're going to write 4.5 IY. 1,000 is your future value because that face value is in the future. 20 is your N, and you'll compute the present value. So either way is good. Let's do it on the calculator here. So 30 payment, 4.5 IY, 1,000 FV, 20 N, compute PV, 804. Again, the negative here doesn't matter, so I'm ignoring it. 804.